Hello and welcome, everyone. Glad to have you. See, we've had quite a few of you just joining in. We'll get started here right at the top of the hour, about 6 minutes till our start time. If you are on the web page, you'll notice that there is a chat portion, and so I appreciate those of you who are already participating in that. And we will address your questions at the end of the presentation. You guys are jumping right to it, so I love it. Great stuff. We will cover a lot of what you're asking about in the presentation. So, for those of you who are already rolling with that Q&A part, we will definitely get to you. I'm coming from Michigan here, so nice to see you wherever you're from. I don't. We typically get people from all over the country. I know the last there's like 2 or 3 weeks in a row where we had someone from, Alaska every week. I couldn't believe it. I asked, "Are you this did you attend before?" And they said no. So, a couple of them I actually met with face to face. So I do know that there were at least 2 for sure, 2 confirmed Alaskans, but, um, yeah, I don't know how much that is. We'll get started here in about 4 minutes. If you have anything that you wanna get as far as, note taking, a beverage perhaps, whatever gets you settled in, we'll get started here in about, 4 minutes. I know a friend of mine who's in, has a place in, Tahoe and has been enjoying the, tail end of the winter season and all the skiing and snowboarding that happens there. He sent me a picture that they just got dumped a ton of snow, and we here are finally just thawing out in Michigan. So I can now see the ground, and it's actually been raining today. So we'll see if tomorrow. Hopefully, it doesn't ice over too bad overnight. But yeah. I think sometimes that I should just do a Q and A present or just maybe really truncate the presentation to a certain extent, really shorten it down and then just go through questions because you guys always have good questions. Um, Maybe we'll just do a Q and A presentation sometime. That might work. But you're firing off with questions already. I love it. If you're watching on the YouTube or Facebook platform directly, you can do questions there as well. And then right on the website, I see that many of you are already figuring that out. So feel free to use that to ask your questions. Again, the Q&A will be at the end of the presentation. So when you drop them in there, I will absolutely come back to them. So don't worry about that. I don't know if my tech team is listening. They usually are. But I noticed that the time on the chat is not Eastern time. It says it's Eastern time, but it's definitely not Eastern time. So uh, I'm going to send them a little note here. We're going to get started here right on time. Got about 2 minutes till our start time. If there's anything at all that you need to do, um, please feel free to do that. See, we have a bunch of you just joining in, and glad to have you. As I mentioned, we'll get started here in about 1 minute. 1 minute till our start time. Okay. Welcome to a Financial Resource Academy presentation of Retire Right, unravel the Social Security mystery in 1 hour. And we will do our best here to pull that off during our hour-long time that we have together. My name's Kyle McCauley. I'm one of the presenters here at the Financial Resource Academy. The Financial Resource Academy is a national organization, and our mission is to provide financial information to many folks at various stages of life. Probably our most interested group of folks is the retirement community. And so we know that those who attend this presentation are certainly and obviously most often in that retirement phase or getting very close to it. And so we welcome you and to our most popular presentation on Social Security. Our agenda for today, we are going to spend just about an hour on the topic of Social Security. We'll do our best to cover as many things as we can in that hour time together that we know will just be really relevant and meaningful to as many of you as we can pull off in our 1 hour time together. At the end of the presentation, we will do two things. We know that many of you want to get a copy of our Social Security filing workbook. That will be made available to you, and we'll tell you exactly how you may request that. And also, we will go into a Q&A portion of the presentation where you can type in your questions into the Q&A portion down below the video if you're on our site. You could also type into the chat if you are on YouTube or Facebook directly, and I will see all your questions and I will answer them for you. So please do feel welcome to do that at any time during the presentation or otherwise. I'll see them once we get there. Okay, my name is Kyle McCauley. I am, in addition to being the father of four and and a little sleep deprived because of those four wonderful children, and the husband of one, and also a national presenter here at the Financial Resource Academy. My primary role in my day-to-day job life is as the Chief Investment Officer of Entrust Investment Services. I should share with you a little bit about my background just so you kind of understand what my perspective is when I provide this presentation and information to you. In addition to being the Chief Investment Officer, I'm also a Chartered Retirement Planning Counselor. This was fancy letters underneath my job title. An accredited portfolio management advisor. And lastly, but certainly not least, I am also a National Social Security Advisor certified professional. The National Social Security Association is the only uh, accredited Social Security education resource available in the marketplace. It's the only accredited designation. So it's just I just highlight to say that there's more than 2,600 pages of Social Security law. And so it's not something you can accidentally become an expert in. It does require ongoing education and staying up to date, certainly with any law and rule changes that come down the pathway. And so when you're thinking about making your decision, we do encourage you to make those decisions with someone who is a certified professional. We are in no way employed by, nor are we affiliated with. I apologize, I'm getting over a little bit of a cold. I will do my best to not snuffle too much here. We are no way employed by, nor are we affiliated with the Social Security Administration. The purpose of our presentation today is not to sign you up for benefits. The purpose of our presentation is to provide you insight, wisdom, guidance into making a high quality Social Security filing decision that comes from our work as a registered investment advisor and helping folks coordinate their Social Security timing and plans with their other sources of retirement income. And so that's our job here today. Why is Social Security such a hot topic? Why are all of you here? Why is it that whenever I do one of these workshops, every week we have anywhere from 30 to 50 households that join in and follow along with us and engage with us to get questions answered and try to sort this all out week after week after week? Well, the reality is there's just a lot of you. There's 3.64 million new folks every year who are qualifying for Social Security benefits. That's been going on for the last 12 years and is still going to happen for another six. And so it brings up issues and concerns about insolvency. Will there be a benefit for me? Those types of concerns often come to the forefront of people's minds as they're thinking about what do these benefits really what's the end result, and how am I going to get those dollars, and will there be any dollars? The impact of Social Security has become more impactful over time because Social Security is a source of guaranteed retirement income. 65% of middle income Americans generate more than half of their retirement income just from their Social Security dollars. That is a highlight of just how important these Social Security dollars have become to many folks' retirement income plans. Since 1985, pensions have just been going away, disappearing, vanishing. It just has happened. More than 84,000 pensions are gone. That's not including the number of pensions that we've seen get frozen, flipped into other types of pension plans instead of a certain income stream. It's instead of a defined income plan, it's a defined benefit plan. It's a defined contribution plan. So all of these sorts of things have caused Social Security to become far more impactful and far more important to today's retiree. Now, 46% of Americans today pass away with less than $10,000 to their name. And again, that statistic is not here to frighten you or scare you or to say, hey, you should be worried about that for you. Maybe some of you it should, maybe others, you're not too concerned with it. But the point of that statistic is to highlight that Social Security, even if you happen to be the person that passes away with less than $10,000 to their name, so long as you qualified for a Social Security benefit, those dollars are going to keep paying to you, whether you live to 90, 100, 120, whatever it is for your lifespan. If you qualify for a Social Security benefit, that payment will still keep coming to you. That's very important in the context of how should you frame your Social Security benefits into the context of your retirement plans. See, if you were to ask yourself, do I insure important financial things in my life? Most of you would say, yeah, of course I do. Do you insure your house? You bet. How about your health? Of course. Your car? Absolutely. But do you insure your retirement? The answer for most of you is yes. When you frame in Social Security and say, how should I be thinking about these benefits? The correct way to think about them is as retirement income insurance, or you could say longevity insurance. Longevity insurance could be pretty important. People are living much longer than they ever expected to. The number of folks that I talk to about their Social Security planning needs who tell me, yeah, I have a parent over the age of 90 is staggeringly high. I've never, kept track of it in a mathematical form, but if it was over 50%, I would not be even a little bit surprised. People are simply living much longer than they ever expected to. My granddaddy lived to 92. He had 4 heart attacks and 3 bypass surgeries before he was 70. I mean, if you had asked him, hey, you think you'll make it to he just would have said, no, I'm not going to live to 90. That's crazy. But medical technology, my granny kicking him in the rear to a certain extent, people are living much longer than they ever expected. Again, enhances just how meaningful Social Security could be to you, your family, your lifestyle, your monetary goals over the course. Now, I don't know if you can live as long as this young lady, Ms. Ethel Caterham. She is currently the oldest living person at the age of 116. And if someone wants to fact check me, I did not check before we started the presentation. So that was true for sure last week. I actually don't know if this week, if it is still true. All right, here's what we're going to focus on for today's presentation. I do want to make sure that we talk about some of the changes that occurred for Social Security that affect everyone, whether you're single, married, divorced, widowed, doesn't matter. Everyone's affected by a certain number of these changes that occurred here in 2026. There were some things that we should talk about for spousal benefits that are especially important in the conversation of cost of living. So, my third bullet point here, you'll see the COLA fiasco affecting all recipients. Well, we'll talk about what that really means. I know that it's something that is somewhat unique about our presentation, or at least that's what others have shared with me. And so I know you'll get some value from that. But really considering how cost of living affects your benefit over time can be a big deal to your total retirement income plans. We'll talk about some rules for those who are divorced and for those who are widowed. And then please do pay very close attention when we get to our last bullet point. The earnings test certainly becomes material for those of you who would like to retire early, but then the big one is taxes. I can tell you from running thousands of analyses now that uh, if there's one single item that could take two strategies that they kind of look the same, this one's okay. This is, they're not too far off, but then it changes it and it goes, no, we got to go this way. It's the issue of taxes. So I do want to make sure that we have enough time to really detail that out for you all. Let's talk about some basics of Social Security. Probably most of you know this, but in order to qualify for a Social Security benefit, you need to have 10 years worth of work. The way the math works is actually one credit per calendar quarter. $1,890 per year of earnings gets you one credit. So multiply that by four, you can get up to four credits in a year. And then if you do that 10 years in a row or 10 times total, no matter when those years occurred, you got your 40 credits and you have now qualified for a Social Security benefit. That substantial earnings number of $1,890 is not that substantial, right? So you notice that. But the key is that those earnings do go up every year. So every year, the earnings requirement does tend to increase over time. And so that's what you're seeing there. I noticed that someone is asking if there's a stream going, and I don't know how to say this in the chat, but if someone is listening who's in the chat and can type click play, just click play. Okay. All right. Thank you. Apologize for the little side note there, but I saw someone saying that. I also see someone, I think it's the same person saying that there's no volume. So if someone can confirm that you hear me and that the stream is going for that particular person, there may be an issue on their end. And I would appreciate your assistance with that. Just type it into the chat. Thank you. Okay, let's keep going. If my tech team is still on with me, I know they hop in from time to time. You guys can also type in. That'd be great. Okay. The way your Social Security benefit is actually calculated is by taking the highest 35 years of indexed earnings. So it's not the most consecutive 35 years. It's not the most recent 35 years. It is the highest 35 years, no matter when those years occurred. So please keep that in mind. Some people think, well, I took 10 years off work, in the middle of my work history, so I got to keep working to make that up. So long as you have all 35 years, you don't have any zeros on your record. And so you don't necessarily need to keep working to help your benefit. Now, it may be that that your benefit will go up because of your continued work, but even that's not guaranteed because it's the highest 35 years. So if your earnings that you have today are less than lower income years in the past, well, you're not replacing any of those lower income years from the past. And so your work today is not increasing your benefit. On the flip side, though, if you are doing some additional work and you're replacing a lower income year in the past, then yes, your work today would be increasing your benefit for the future. Now, I think you know this, but if you don't, you have been paying a lot of money into the Social Security system. 6.2% of your pay over the last 10, 20, 30, 40, however many years you have been working has been going into the Social Security system. Your employer matched that for a total of 12.4% of your pay. And unless, of course, you were self employed, then you got to pay both. Now, today's contributions, meaning those tax dollars flowing into the system right now, are leaving the system right now to pay current recipients. So, although that you have a work history record and you have all the records of all the taxes you've paid, and you can see that on your Social Security statement, it is not as though you have an account at the Social Security system with your money in it. I think if you were to imagine an account somewhere with your name on it, with your money in it, and you applied even a little bit of interest to those dollars, 12.4% of your pay would be a quite sizable amount of money. But that's not how it works. We are on a pay as we go system. And that pay as we go system means that sometimes we're in the black and the Social Security Trust Fund is buying treasury bonds. That's the only asset they're allowed to purchase. They're buying treasury bonds, effectively loaning money to the government. Out of Social Security. So, have you ever heard, hey, the government borrows money from Social Security? That's how they do it, right? Every time the Social Security Trust Fund buys treasuries, it's effectively the government borrowing money from Social Security. Now, they're paying interest, so it does help the Social Security system, but not that much. And so this is the issue. If you look at the first bullet point on this page, you'll see here that it says that in 2010, we started operating Social Security in the red. That means that the funds flowing in to pay from payroll taxes to pay current recipients, we no longer had an excess. The excess was gone, and we are now selling treasury bonds to fund the difference. Uh, in 2010, that was the first time we ended up in the red since 1983. 1983, Social Security was in the red. And if you are a historian or know this from maybe a little factoid, 1983 was the year that the Reagan administration added taxes to Social Security. So that was one of the first fixes. Is they said, "Hey, Social Security is no longer tax free. You have to pay federal income tax." The second time they did something with taxes was in 1993. 10 years later, they increased the tax. So that was, of course, President Clinton. So whether you're on the red team or the blue team, we could all be upset together. Okay. All right. So we're fully funded through the year 2034 on our current plan. That means that the dollars flowing in to fund the Social Security Trust Fund, plus the current still accumulated number of treasury bonds that the trust fund has, we are able to pay the estimate for recipients that will need to be paid, and we're good through 2034, 8 years from now. In 2035, Social Security Trust Fund estimates that we're funded only 77 cents on the dollar thereafter. So we're underfunded by 23 cents for every dollar of commitment beginning in 2035. Now, Social Security law says that once you reach the age of 55, they cannot change your benefits. So they're going to have to fix this. What will they do to fix it? Because they can't touch current recipients or anyone over the age of 55. Well, whatever they do to fix it is going to affect your kids and grandkids. You kind of should know this already intuitively because your full retirement age for the oldest of you is 66. The youngest of you is 67. And there might be some of you on here who are full retirement age of 66 and some number of months. Well, all of your parents had a full retirement age of 65. The difference between a full retirement age of 65 and 66 and 67 is not a change in the calculation for the dollars and cents that you're able to receive. What it is a change in the timing of when you can get those dollars. So it's not a true reduction. They didn't go in and say, "Yep, you were expecting to receive 2,000. Nope, cross that out. Now you only get 1,800." They're not doing that. What they're doing is saying, "Yeah, you were planning on this at 65, but we're going to bump you out to 66 instead. So you still take it at 65, but you're going to get less." Or if you went from 65 to 67, same thing, right? Well, you got to wait 2 years to get the same amount that you would have gotten at 65. Oh, and by the way, you could take benefits at 65, but it's going to be reduced that much more. Okay. So that's essentially what they will do to fix it. They'll just do it to your kids and grandkids. The other likely thing that they may do is all of you can file for benefits as early as 62. Very unlikely that that will be retained. Lots of talk around pushing that minimum filing age up to 65. No longer can someone file at 62. The Social Security Fairness Act of 2023 was a wonderful act for anyone with a government pension who also qualified for Social Security, but they didn't qualify for enough Social Security that it didn't affect them negatively when they tried to claim both. So, what the Social Security Fairness Act said is, okay, we're going to eliminate all those reductions. So now a person with the who was previously affected by the government pension offset or the windfall elimination provision, they are no longer affected by that. What did that do for everybody else, including those folks? It cost the Social Security Trust Fund 3 years. So eventually they'll have to fix it. But in the meantime, they made it worse. So they made it worse by 3 years. So you see here it says fully funded through 2034. It was 2037 in 2023. But of course, with the change, we lost 3 years. So they just means they're going to have to fix this a little sooner, we hope. In 2026, this is the first year that there is now no one who hasn't already reached their full retirement age who has a full retirement age of under 67. So if you have a full retirement age of 66 or 66 and some number of months, you've already passed your full retirement age. Everyone now has a full retirement age of 67. So if you look at my chart here, what you'll notice is you go down the left side, you see retirement age, go down to 67. Look over to the right, it says 100. 100 what? 100% of your primary insurance amount. So your primary insurance amount is the amount that is calculated using the AMI, then applied to bend points. Somewhat complicated calculation process, but that's how your actual benefit is determined. The AMI stands for average indexed monthly earnings. So they take your average indexed monthly earnings, they then divide it out to see what those average index monthly earnings would be. But then they apply bend points so that lower income earners get a much higher percentage of their income that they earned while in their working years. They get a much higher percentage returned to them. Uh, Higher wage earners get a much lower percentage of their working income returned to them through Social Security. But that primary insurance amount is the value that is used to determine everything else. So once you know your primary insurance amount, you can see here that at the top of the page, age 62, you are eligible to receive 70% of your primary insurance amount. Meaning, if you have a $2,000 a month Social Security benefit at full retirement age, at 62, you're allowed to file, but you will not get $2,000. You'll only get 1,400. Now, after reaching full retirement age, you can delay and earn what are known as delayed retirement credits. Those delayed retirement credits stop at the age of 70. And so it is simple interest, 8% that you can earn, turning a $2,000 a month benefit. You look down on the right hand side of that chart, 124%, $2,480, age 70 benefit. Again, simple interest, not compound. There are three distinct benefits that you could potentially be entitled to. The first is a retired worker's benefit. This is a benefit that you would be entitled to based upon your own work history. A spousal benefit or an ex spousal benefit is a benefit that you're entitled to based upon a spouse or an ex spouse's work history. And then widow or survivor benefits are benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex spouse's work history. The only difference between a widow benefit and a survivor benefit is a survivor benefit is what's available if the spouse that passed was already receiving Social Security. If the spouse that passed was not already receiving Social Security, then it's a widow benefit that's available. There's no real difference in the rules, but there are some differences in the amounts. Considerations for those who are married. If you are married and you are thinking, I've heard about this spousal benefit ordeal. What exactly can I collect from spousal benefits? Well, the amount that you're eligible to receive is 50% of your spouse's primary insurance amount, but you're only eligible to receive that amount or your own, not both. So if I have a $500 a month benefit and my wife has a $2,000 a month benefit, half of hers is $1,000. That's more than my own. And so I don't really need to worry about my benefits so much. I'm just going to file based on her work history to get the full thousand. Now, if I had my own benefit of 1,200 a month, 1,200 is more than 1,000, and so in that scenario, there's nothing for me to worry about with the spousal benefit. I'm just going to get my own. Again, you cannot get both. There's no double dipping. There's no some of this, some of that. It's whichever of the two is higher. That's what you receive. Now, in order to qualify for a spousal benefit, you do need to have been married for at least 1 year. And the primary worker has to have filed their benefit. So it is not allowed for me to file that $1,000 in the example I just gave if my wife has not yet filed her benefit. On the flip side, though, if I do have my own benefit, say that $500 a month, I could claim that on my own timetable. And then when she files down the road, I could switch and get the spousal portion. That is allowed. Now, spousal benefits reduce at a faster rate. And what I mean by that is if you look at the top of this chart here, you'll see that if I file for my own benefit at the age of 62 and that benefit is $1,000, you'll see 70%, meaning I would get 700 bucks a month. But what if it's not my own? What if it's a spousal benefit? Well, in that case, you look over two columns and you see 65%. So, right, if it's a spousal that I file at 62, I don't get 700, I only get $650. So, if you want to think about it like extra penalties for spousal benefits when you file early, that would be a fair way to say it. Second point, there are no delayed retirement credits on spousal benefits when you delay. If you delay taking benefits past full retirement age, you can earn delayed retirement credits on your own benefit. Meaning, if I have my own $1,000 a month benefit and I delay till 70, I get 1,240, 124%. But again, look the next column over, spousal benefits do not work that way. That $1,000, if I delay till 70, is still only $1,000. Caveat being would be COLA adjustments, but that's the same dollars regardless. There's no additional dollars available to me by delaying till 70. Simply said, spousal benefits, if that's the higher benefit you're entitled to, you just don't want to delay past full retirement age. There's nothing in it for you to do that. Survivor benefits apply whenever one spouse passes away. So, if you are a married couple and your spouse predeceases you and they had the higher benefit, you will say goodbye to your benefit and you will keep theirs. If you had the higher benefit and they pass away, they're simply going to take their benefit with them. You'll just keep your own higher benefit. So only one benefit remains. It's always the higher benefit of the two. The only caveat to that is our last bullet point here, and that is the 82.5% rule. If I had a higher benefit of $2,000 a month than my spouse, and I file that at 62, I'm only getting 1,400, 70%. So, what happens if I predecease my spouse and my benefit's the higher one? Well, that 1,400 would bump up upon my passing as a survivor benefit to my spouse to $1,650, 82.5%. Two most common mistakes we see married couples make. The first has to do with this issue of when one of you pass away, only one benefit remains. Higher wage earner files early, shortchanging the surviving spouse. So if I pass at 70 and I filed at 62, everyone cheers and says, "Great job. He knew he wasn't going to live long. He filed early and got those Social Security dollars while he could." But if my benefit was the higher between my spouse and I, and then my spouse who I leave behind lives to 90, maybe they outlive me by at least 20 years, maybe 30 if they're a little younger, you get the point. That is locking in that lower benefit for that surviving spouse for 20, 30 years. So, very important to remember that if anyone is going to do any delaying on their Social Security benefits, it's always going to be that higher wage earner. Generally speaking, for married couples, one person delays to some degree and the other files early to some degree. Usually there's tax optimization reasons for that, and that just comes from my experience in running hundreds of analyses. Let me double down on the issue of having a low Social Security benefit. Now, for some of you, you may not have a choice, right? You didn't have a ton of earnings and the Social Security benefit is small. Maybe you've had some unfortunate things happen. You had to go on Social Security disability. Maybe you've had some unfortunate things happen. You got laid off and you're now unemployed. You think you're retired and you kind of need Social Security to be coming in. So I'm not, for those of you who have inflexible income plans, I'm kind of not talking to you with this. But for those of you who do have the flexibility to structure your retirement income in a strategic fashion, one very important variable that you must not neglect is the issue of how COLA affects your benefit. In 2026, the cost of living increase to Social Security was 2.8%. That means that someone with a $1,000 a month benefit would have seen their benefit increase to $1,028. But what if that person was also a Medicare recipient or payer, I guess I should say? If they're on Medicare, they also will have Medicare Part B premiums. Medicare Part B premiums do not increase as a percentage or based upon your income. They don't really care. They increase it the same amount for everyone, regardless of your Social Security check and your total income. Well, there are some things about total income called the IRMA that can affect you. So if you're familiar with that, but outside of that, the baseline COLA increase affects everyone the same. Medicare Part B this last year went from $185 to $202.90, a $17.90 increase. Let's do the math. A $1,000 Social Security check at 2.8% COLA grows to $1,028. But what will that person actually get when they receive that check? See, most people have Medicare deducted from their Social Security check. That's perfectly fine. It's the same dollars and cents whether you have it deducted or not. But the point is what's the real COLA if you have that deducted from your Social Security check? You got $28 in the increase minus $17.90 from the Medicare increase. Your Social Security check only went up $10.10. Last time I checked, that's a real COLA of 1.1%, not 2.8. So I don't know what real inflation is going to be over the long haul. I'm not even convinced necessarily that it's only 2.8% over the last year. Just go to the grocery store to figure that one out. But the point is it's definitely more than 1.1%. Having a smaller Social Security benefit, structuring your plans, structuring your decision about timing of when you file for those benefits in a way that reduces Social Security causes this COLA issue to affect you more. Let me give you an example for why I say that. Down below, you'll see that if you have a $3,000 a month benefit, that 2.8% increase increased your Social Security benefit by $84. Again, the Medicare premium increase is the same whether you have a $1,000 Social Security benefit or a $3,000 Social Security benefit. So we're still deducting $17.90. The increase for someone to their Social Security check from 2025 to 2026, if they had a $3,000 a month benefit, was $66.10. Their real COLA is 2.2%. So they got more than double the COLA increase compared to the smaller Social Security recipient. So, there again, when you are thinking about your Social Security decision, do not neglect the issue of how inflation and the COLA increases and the Medicare increases can and will affect you. This kind of long-term issue is insipid. It can slowly erode the value of your Social Security dollars over time. You just don't need that to happen unless you don't have a choice, right? That's the only issue. All right. Divorced benefits. There are no changes to divorce benefits here in 2026. All the rules are identical. You have to have been married for more than 10 years in a row to the same person. You can't, married 7 years, divorced, remarried, even to the same person, 5 years, divorced. 7 plus 5 does not equal 12. One of those two has to be 10 years in order for those divorced spouse benefits to be retained. Now, I know that none of you came on here for marriage counseling, but if you needed a reason to hang on, there you go. Same benefit amounts in terms of extra penalties when you file early and no delayed retirement credits when you delay past full retirement age. Apply for those divorced spouse benefits in exactly the same way as they did for spousal benefits. The one major difference between divorced spouse benefits and spousal benefits is our last bullet point. With a spousal benefit, you have to wait for your spouse to file in order for you to claim spousal. But what if it's not a spousal, it's a divorced spouse benefit, and you've been divorced for at least 2 years, then you can file independently. So whether they've filed their benefits or not, doesn't matter. You can file on your own timetable. Let's talk about considerations for those of you who are widowed. Widow benefits also did not change in 2026. You can still file as early as the age of 60, but you do have to remain unmarried if you were widowed prior to reaching the age of 60. Widow benefits are qualified for once you have been married for at least 9 months. But this provision is not here to hurt you. It's just here to prevent deathbed marriages. So if you had a marriage that lasted less than 9 months and you're thinking, yeah, well, I guess I lost out on those benefits, but you can provide documentation showing that it wasn't like a deathbed, it wasn't some known, terminal illness. You can typically get those widow benefits reopened. Let's talk about the earnings test. The earnings test applies whenever you file for Social Security prior to reaching your full retirement age. So if you're 62, 63, 64, 65, 66, before you turn 67, if you file for Social Security, Social Security will ask you, will you work? And the reason they're asking you is because of the earnings test. And if you say yes, they're going to want to know how much. And if you say a number that is higher than $24,480, you will be subject to the earnings test. Last year, that number was $23,400. It typically goes up every year. So if you're a few years away from your retirement and you're thinking, well, maybe I want to work part-time, but I also want to retire at maybe 64, supplement with Social Security, well, you have to deal with this earnings test in that scenario. Okay, so $24,480, if that's your income, Social Security doesn't care. But the minute you go above that number, Social Security cares, and they care about $1 for every two that you earn above the limit. Let's say you have an $84,480 income. The first 24,480, Social Security takes off the top, meaning uh, you now have 60,000 over the limit. 60,000 over the limit is how much is over the limit. And remember that I said they care about one for every two above the limit. So we chop it in half. So you are ineligible to receive, in that scenario, $30,000 from Social Security. Let's say the benefit that you're filing for is $3,000 a month. $3,000 goes into 30,000 10 times, meaning they will not pay you a check in January, February, March, April, May, June, July, August, September, October. 10 months, 3,000. That's your 30,000 that you're ineligible to receive. Then you would receive a $3,000 check in November and a $3,000 check in December. Some people mistakenly assume that they'll get a check all year, but just be a reduced amount. No, they simply will not pay you anything until you have paid back that which you were ineligible to receive. Now, the right hand side of this page, in the year that you turn your full retirement age, but before you turn your full retirement age, you can earn up to $65,160, and the earnings test is a 1-for-3 calculation. Again, that side of the page almost never applies to anyone, but it is how it works. Okay. The earnings test goes away the minute you reach your full retirement age. So once you hit 67, for all of you here, if you're younger than that for your full retirement age, you've already hit it. But once you reach age 67, no more earnings test. You don't have to worry about it. Let's talk about taxes. Taxes in the year 2026 and into the future have had some significant value adds for most retirees. There were increases to the above the line deductions. There were some increases to the standard deduction, all courtesy of it was not just affectionately called the One Big Beautiful Bill. That is the official name of that bill. The One Big Beautiful Bill, OBBB, you may have heard it called or seen it written out, did provide to most retirees some additional tax flexibility. It did that in a few forms. One was the increase in above the line deductions. So now you can contribute up to $1,000 without itemizing your taxes and fully deduct that $1,000 off your tax return. That's per person. So if you're a married couple, it's $2,000 of additional tax deduction you can take above the line, no itemization required. You can also deduct vehicle loan interest on any loans that started after the year 2024 on American-made vehicles. There are some restrictions there. I think it's actually technically assembled in America. But those deductions for vehicle loan interest are also available. You could deduct minimum you have to deduct is $600 of interest. The maximum you can deduct is up to $10,000. Again, above the line. So this does not require you to itemize your tax return. In addition to that, the standard deductions were increased. Now, we all got kind of used to the Tax Cuts and Jobs Act standard deductions increases, but they were increased a little bit more for 2026. So a single tax filer, the first $16,100 of your income is completely tax-free. Married couple, the first $32,200 of your combined income is completely tax-free. If you are over the age of 65 and you are single, you get an additional $2,050 of standard deduction, taking your standard deduction to $18,150. Married couples, you get an extra $1,650 each, meaning you get an increase of $2,300 if you're both over the age of 65. Now, With some income limitations, there is an additional $6,000 of standard deduction that's available to those of you who are over the age of 65 between 2025 and 2028. In 2029, this goes away, but well, it sunsets unless they extend it, of course. But that extra $6,000 means more income that you can have with zero taxes. The maximum, no itemization required for someone who's already retired over the age of 65, of tax-free income you could potentially have as a single tax filer, it's $35,150. As a married couple, the maximum total tax-free income that you could potentially have if you took advantage of all of your above the line deductions and standard deduction is $59,500 of tax-free income. What does all that mean? It means that it opens up for many folks additional planning opportunities like Roth conversion planning, for example, or restructuring or being strategic about the timing of the sale of assets, for example, that could really provide some additional benefit to many of today's retirees. Publication 915 is produced by the IRS every year and will tell you everything you could possibly want to know about how you'll pay taxes on Social Security. Now, one thing that the one big beautiful bill did not do for us is it did not eliminate the taxes on Social Security benefits. Some people thought it did. Even I did a video on it because it was so prominent that bill took away taxes on Social Security. It's misinformation that AI was tricked. So if you asked your AI, it would tell you that, yeah, no, there's no taxes on Social Security anymore. Not true. There's still taxes on Social Security. It's still complicated. This report, I don't know if you could see it, but it is 33 pages. So nice. There's some helpful things in this 33-page document, like this worksheet. This worksheet will walk you through the 19-step process that you have to go through to determine how much tax you're going to owe on your Social Security benefits. Now, for most of us, there's going to be a software package that will do it for us, TurboTax or whatever. Maybe some of you ship it off to the accountant and they're going to use their tools or whatever. So very few people actually go through and line item this. I have a couple clients who do, but very few people actually go through it like that and go through the detailed process. But it is actually 19 steps. What does that mean to you if you're not filing your tax return? Or excuse me, filling out your own tax return? Well, what it means to you is that it's complicated. Even if there's software simplifying it, it's complicated. What does that mean? It means that there's opportunities for you to save taxes or pay more taxes than you should because it's complicated. If you have a provisional income being all of your modified adjusted gross income, earnings, W-2s, 1099s, annuity income, pension income, withdrawals out of 401k, IRA assets, interest income, dividend income, all sources of income that you have, plus non-taxable interest, municipal bond interest income, plus 50% of the Social Security benefits you're receiving get combined into this magical number that you've never had to deal with ever before in your life called provisional income. If the combination of those three items is more than $25,000 and you are single, you'll be paying taxes on Social Security. If that number goes above 34,000, you could be subject to paying tax on as much as 85% of your Social Security benefits. Married couples, if that number for you goes above 32,000, you start paying taxes on your Social Security benefits. If that number goes above 44,000, you could be subject to paying tax on as much as 85% of your benefits. The question is how much tax are we talking about? Well, this is where it gets complicated. Let's say you're cruising along through retirement and everything's going pretty good. You've got maybe a small pension, Social Security's coming in, or you're taking some distributions from your IRA or 401k, but fine, right? Everything's going well. But this year, your spouse says to you or your loved one or a friend or a neighbor or, whoever, hey, what did we retire for? We got some stuff we want to do. We got some bucket list items. So let's go do that. I mean, saved all this money. What did I save it for? I saved it for me. So you say, great. Yeah, let's do it. Maybe it's a trip. Let's say you're going to go on a trip. I know some of you maybe aren't big travelers, but you want to buy the RV or you want to remodel something around the house. I have one client who, told me, we're just not big travelers, and the spouse had some health issues. We can't really go far. We got to be able to access our doctors if we need it. But you know what? I just have this dream of this beautiful a greenhouse. I mean, it was gorgeous, and just a place that she loved to spend her summers. And yeah, so whatever it is, whatever your bucket list item is, you're gonna do it. And let's say you're budgeting it all out, and whatever it is, it's gonna cost you about $20,000. Okay. Maybe you're booking all the airfare and the hotels and you're throwing it all on the credit card, but you don't carry a credit card bill. So, it's time to pay it off. So you survey your accounts and say, well, I got to pull money from somewhere. Where am I going to pull it from? You look over and I got this 401k plan sitting over here. I mean, it seems like it's doing pretty well. Keeps going up. Market's bouncing around a lot, but all in all, I seem to be doing pretty good. So you call up your 401k plan, say, I'd like to pull $20,000, please. And they say, great. And then they, at some point, ask you a very important question. How much tax would you like to have withheld? Oh, yeah, yeah, of course. Yeah. Taxes, obviously. So maybe you bump up your distribution a little bit, but let's say you don't. Let's say you had the tax money on hand, but you still have to have it withheld. It's a requirement. So you say, well, I'm in the 12% tax bracket, so let's withhold that, please. They say, no problem. They send you your money. You pay off the credit card. You go on your trip, or you build the greenhouse, or you buy the RV, or whatever it is. The point being, everything looks good. You get to next year, punching stuff into TurboTax or whatever software you use, or you've shipped it off to the accountant or whatever. Point is, TurboTax, if you've used it, has this fun little number at the top that usually, like when you punch stuff in, I got 4 kids, so often it turns green for me, and then I start loading all the income, and it turns red, and then, I start loading in all the stuff I've paid and the deductions, and then maybe it turns green again, and you want to finish your TurboTax experience with green. Right? Nobody wants to finish with red. If you don't need a lot of green, like giving a free loan to the government, but you'd like to see that number turn green. But this year it won't turn green. It says it's red still. What's going on? I always withhold enough taxes. TurboTax is broken. Maybe you hop on the chat or you call the 800 number, or maybe the accountant calls you and says, "Hey, did you pay enough tax last year?" And you say, what do you mean? I thought it was your job to make sure I paid enough tax. The point is that, yeah, you owe tax. But what happened? You took 20,000, you're in the 12% bracket. That was right. Where did this go awry? Here's what happened. When you took that 20,000 out, you were in fact in the 12% tax bracket. You had them withhold 12%. Perfect. What you didn't account for is the fact that you were above these limits. When you're above these limits and you add additional taxable income, you cause additional Social Security dollars to become taxable up until you hit the max. And so, in this scenario that I'm describing, what you forgot about was that you caused previously tax-free Social Security dollars to become taxable. And so 20,000 of income taxed at 12% plus causing an additional 20,000 of Social Security to become taxable at 12%, the effective tax rate on that distribution was actually 24%. Well, that's a bummer. Nobody wants to hear that. You don't want to write a check for 2,400 bucks to the IRS, but you're not gonna make that mistake again. I mean, because you're diligent, right? You put the money in the accounts. You built them up. You got the free money from your employer with the matches into the 401k. You did smart stuff. Let's get our expenses reduced. I'd like to retire. I don't want to be a burden to my family someday because I overspent. So let's get the spending down. Let's manage this. And so you do it. And you get into retirement. You've got your Social Security, you've got some other retirement income coming in, but you're not pulling too much from that 401k account that you built up over the years because you want to make sure that you can take care of yourself in your old age. You want to make sure that if there's a medical expense later in life that yeah, you're not going to be a burden to your family. You can pay for it. Unfortunately, all of that due diligence and diligence more broadly backfires for too many people. And it doesn't backfire in the sense that it would have been better if you hadn't saved. No, that's silly, right? It's great that you saved. It's great that you got your expenses down. But unfortunately, I see all the time that people hit this wonderful magical age 75. Well, some of you are going to be 73. That is the age of required minimum distribution. Required minimum distributions for all of you on this call, unless you happen to be older, are probably either 73 or 75. That required minimum distribution age is mandatory. It's not optional. When you hit those ages, happy birthday, you must pull from your 401k, IRA, 403b, 457, TIAA, TSP, all of these simple IRA, SEP IRA, traditional IRA, all of these accounts that you got a tax break for putting money in. You've paid no taxes along the way, but it's time to pay the piper, as they say. The IRS is now ready for you to mandatorily pull from those accounts. And when you pull from those accounts, taxes are due. The larger the account is, the larger the distribution. It's not a percentage, it's a divisor based on your life expectancy, but the first year turns into roughly 3.65%. So obviously, 3.65% of $1 million account is a much larger number than of a $200,000 account. But that extra income that mandatorily must be taken from those accounts also goes up every year. And it is not uncommon for me to see folks who not only when they turn their required minimum distribution age and they have to pull out more money from those accounts, do they often set themselves up to double their taxes in retirement, sometimes more. But in addition to that, they start putting a lot of pressure on their accounts because not only are they just bumping up their income, but they're also sometimes bumping up their tax bracket. Imagine this. I take a required minimum distribution. Now my income is such that I'm not in the 12% tax bracket anymore. I'm in the 22% tax bracket. Now, as I've added more Social Security dollars to my taxable situation, I'm no longer doing 12% bracket plus 12% bracket being 24%. I'm doing 22% bracket plus 22% bracket being 44%. These are the kinds of tax mistakes that we really would like to see you avoid, but it does require pre planning to make sure that you do that. Quick case study that kind of highlights this issue of taxes and how important it is. Clients are 64 and 62. They have just over $34,000 in combined Social Security income if they file for benefits right away at the age of 62. They're going to start their retirement with about 752,000 in 401k and IRA accounts, and they're going to earn 6% per year on those accounts. They will need to spend $70,000 a year to hit their retirement income goal. Look at it simply for just a second. 70,000 minus 34,000 is about 36. Well, it's not about, it's exactly 36,000. I say about in my head because we got to deal with taxes, but it's 36,000. means that they need to supplement from their investments 36,000. 36,000 on $752,000 is around 5%. It's not that big a deal. So this should be easy, right? I'm only spending 5%. No problem. They're spending 5% and they're going to earn 6%. So they should be easy street, right? Here's what happens if they file early with their social security benefits. You'll notice that the social security benefits, that's the blue lines, it's covering about, like I said, half their total income need. But got to deal with taxes. So they're pulling out of their 401k and IRA accounts up to the red line to account for their income goal increasing over time with inflation. The amount of the orange line above the red line is the amount they must pull to pay taxes. So, unfortunately, because of the tax issue, they have to pull a little bit more than the 5%. The issue over time, because even with taxes, the account balance should go up initially. But the problem is very quickly, because of this double taxation process I just described a moment ago, as they pull out more and more money to keep up with inflation from their 401k and IRA accounts, you'll notice the orange lines above the red line are not increasing linearly, they're increasing exponentially, meaning the taxes are being doubled along the way. And eventually they even end up in a higher tax bracket. And you see the taxes really blow up um, towards the end of not their retirement, not their life, but towards the end of the time that they still have some savings. This couple, if they file Social Security early, do not optimize their plan to account for the tax issue. They don't optimize their plan to account for what we just discussed with the double taxation on Social Security. What happens is they run out of money 14 years too soon. Now, if this couple will simply optimize their strategy to account for COLA, account for uh, the tax issue that we just discussed, account for the fact that inflation can be a little rough over time, this couple will choose to put all of their retirement plans on the 401k for the first 8 years. By delaying Social Security for this couple, they put themselves in a position, one spouse filing at full retirement age, the other spouse filing at 68. And when they do that, they s- they start taking Social Security, and they are receiving at that point more than 75% of their total retirement income need from their Social Security dollars. By allowing that to happen, it reduces how much they take from their savings by a lot. It's a very small amount that they have to pull from that point forward. Now, in this case, maybe that would be a little nervous if they didn't have a specific plan, pulling that much money in the early years of their retirement. But you can see very clearly that by doing it like that, they are in a much better position. Their portfolio gets that additional 14 years that they needed. They do not run out of money, and they pay way less in taxes. If we compare the tax picture between the two strategies, the orange lines are filing Social Security early. When they file Social Security early, one spouse files earlier than the other. And then when they're both on it, initially they pay a little bit less in taxes, the orange lines below the blue lines in those first several years. But when they optimize their Social Security filing strategy to account for taxes and they file for Social Security at a later date, look at all those orange lines above the blue lines, the excess taxes being paid simply because they didn't optimize their strategy when they simply filed early. Now, the orange lines eventually go away, but they're broke. It's not a good deal. This couple, by filing and optimizing their plans, they get $186,000 more out of their Social Security benefits. Their portfolio lasts 14 additional years, and they pay $35,000 less in lifetime taxes, even though they weren't paying any taxes for 14 years when they optimize their plan. So, look, after hearing our presentation today, You may or may not feel that you could use a more specified, individualized assessment of your specific situation. We looked at some case studies today about some, a scenario where, someone really benefited from a delayed strategy. I can tell you it doesn't always work that way, though. Sometimes that's not the right plan. So, what's your plan need to look like? If you feel that you need to take a look at this in a deeper way, we are going to make available to you at no cost a free Social Security analysis. This analysis is free, and doesn't cost you anything, and does not obligate you to work with us beyond the free analysis. So why do we do that? Because I don't think any of you paid to be here. And I don't think any of you are paying for the workbook that we're going to talk about how you can request in just a couple of minutes. So then you also get a free analysis. It's too much free stuff, right? Well, here's how we look at the free analysis. It is our experience that when we put this analysis together for folks, that you end up blown away, honestly. I just had a visit yesterday where at the end of the analysis presentation, where I was actually going through the analysis with her and sharing it with her, she said to me, "This is more planning than I've ever gotten before in the last 40 years that I've been working." And I get it. It often is. And, I have sort of mixed emotions about that because obviously I'm very honored that that's true, that I'm sharing such a huge amount of value in such a short period of time. But also, I'm a little sad, to hear that so many folks go underserved as they're building up to and gearing up for their retirement years. They'll often have investments, they'll often have savings, they'll often have a mix of stuff, but do they have a plan? Often cases very often not. So what you actually are getting, although it's a Social Security analysis, is really in many ways a retirement income plan. And the reason I say that is because it includes the specifics about Social Security benefits, telling you exactly when to file, what's the best timing. It's going to show you a break even analysis and how that should go. But probably the single most important and impactful part of the analysis is this: the retirement income, cash flow, and tax analysis. It's going to show you, if you file one way versus another, what does it do to your lifetime taxes? What does it do to your taxes over the next few years versus over the long haul? What does it mean to your kids if that's important to you to leave dollars to them or to your grandkids? What does it mean to you over your lifetime in terms of how much you could spend? Converting dollars from IRA to Roth, for example, yeah, it's a great deal for your beneficiaries one day, but it's also a great deal for you if you ever want to spend a significant amount of money. Pulling out $100,000 out of an IRA, you probably actually have to pull 120,000 at least, just to actually net 100,000. But if that money has been moved over into a Roth over the years, then you could pull out 100,000. It's net net. So the point is that this analysis will help you really evaluate that and get a grip, tight grip, I would say, on what's really going on with your retirement plans and strategies. I'm going to start answering questions here in just a minute. But if you would like to take advantage of that free analysis, you are going to go to the same website that you go to request the workbook. So the workbook and the analysis are requested using the same website. Now, if you are on YouTube or Facebook directly, I think it's going to pop up in the chat. It does not pop on the website chat, but the website you go to is ssworkbook.com. Okay, so ssworkbook.com is the website. That's actually a redirect for those of you who are technical enough to know what I'm saying there. What you're actually going to go to is https://financialresourceacademy.org/workbook. Okay, that's what you see on the right hand side of the screen. You can also use the QR code on the page, snap a picture of that and use the QR code, and that will take you right to that site. Financialresourceacademy.org/workbook. If you're on the website now, you can look up and there would be a you'll see that your URL is forward slash live. You would just change that to workbook, and you can go request your workbook. Also, in that form, there will be some questions about you personally, so we have that information. But then, if you'll please rate us, we're always trying to make improvements to the presentation, so we appreciate your feedback there. But there at the bottom, the last question on that screen is: would you like to take advantage of your free Social Security analysis? And if you say yes to that, it will then take you to some additional questions. Those additional questions we use to make sure that we are fully prepared for your analysis and providing you the best information and analysis that we know will be helpful to you. So if you take the time to answer those questions, it'll tell us what's most important to you and why you're requesting the analysis, and just kind of give us a little heads up and insight. The first visit that we have is an information gathering meeting. So if you're requesting the free analysis, it's going to take you then to my calendar. You'll book a 30-minute visit, fire hose of information. What we're going to do in that 30 minutes is we're going to gather the information that's needed to put your Social Security analysis together. Once that analysis has been constructed, we'll have another visit where we will go through it. That visit tends to be at least an hour long. And we go through that visit together, answering all your questions, giving you the analysis. And I'm confident that you will say, hey, this is great. If you like that process, it is no cost. You are, again, our experience is that you'll be very blown away by it. Point being, we know that there's a good opportunity that we may earn the right or privilege, maybe I should say honor, quite frankly, of serving you with other retirement planning or investing needs that you may have. Okay, so that's why we do it. We don't want to have anything hidden there. There's no tricks to it. We are providing the free analysis in the hopes that there will be some of you who we will get some great value beyond just the free stuff. Okay, so that's that. So do go through that process. I see we have many people who are already requesting the workbook. I see some of you are already requesting the analysis. So that's great. Keep going in that process. And I'm going to start answering questions in the meantime. So let me take a look here. First question: I'm turning 69 this year. I've not filed my Social Security. My mother died in 2025 and I inherited her home through a trust. Got some assets, 670,000 stocks, 200,000 bonds were purchased a long time ago. My question is, should I cash in the bonds and file for Social Security? Two, cash in the bonds and don't file for Social Security. Just cash in some of the bonds and file for Social Security. Okay. I understand what you're saying. Well, one of the nice things is you do get a step up in cost basis. So if you're getting the plan, we can absolutely answer all those questions in detail for you. You're thinking about this logically, but I would just say that, well, the bonds are not earned income, so it's just taxes that you have to deal with. But yeah, there's some optimization points for you that could be helpful. Um, Getting a full and clear picture of your total situation would be important to answer the question. But probably, if you're not getting the analysis, probably number two is closer to the correct answer. Okay. Do I have to get Medicare if I already have insurance through my company? No, if as long as you're still working, you don't have to go on Medicare yet. But once you're retired, you will have to. Can a younger spouse take the spousal benefit and then take their retirement at 70 to get the 124%? Not anymore, Lori. So you have to do one or the other. There's no switch. Oh, looked like my connection blipped for a second. Hope you're still hearing me. So what you're describing, Lori, is called the restricted application. The restricted application applies in the scenario that you're talking about, but it's no longer available. They took that away a couple years ago. What if you were divorced after being married 9 years? You're out of luck. No divorce spouse benefits. Can I still work and get Social Security? I'm 64 and a half. Yes, but you have the earnings test that you have to be aware of. Someone says, "What about Social Security disability?" You have to ask, tell me what you're wondering because I don't know. Social Security disability is your full retirement age benefit early. That's all it is. Okay. Thank you to all of you who helped me out with the click play. I don't know if that helped. I hope it did, Joe. I saw you, but I don't know how to help you other than other people were cruising along. Retire at 62 or 65. What are the benefits of waiting? Lisa asks. Well, I mean, I think we talked about him. If you have a more specific question, let me know. But I think I've outlined what the benefits are. Okay, someone asks, how is the money we get from Okay, hold on. It's the highest 35 years. I think it's asking how it's calculated. How is the Social Security benefit calculated? It's the highest 35 years of indexed earnings. Does the survivor retirement age count at the same as full retirement age? Uh, uh, so survivor benefits do max out at your full retirement age, Karen. Um, but you can file as early as 60. I don't know if that's what you're asking. If you have a more specific question, let me know, but I hope that got it. My Edward Jones guy, Debbie says, told me to wait until 67. I'd like to take it at 64 or 65. What's my best? Well, why did he tell you to wait till 67? I mean, that's the question. I mean, I assume he knows about your personal finances. So, in theory, he's run a report, looked at a break even analysis, analyzed your tax situation, and given you the ramifications of filing at your preferred ages of 64 and 65, and then also showed you the recommendation to wait till 67. And so he is giving you this recommendation based on data and analysis of your specific personal financial situation. He's not just doing what you're doing, which is guessing, right? So I don't know if that's true, but that would be the difference. Okay, Jody asks, oh, it's a follow up question. Let me find your first question, Jody. Oh, okay. I'm just going to go. Jody asks, is it better to use a 401k as income before collecting Social Security for tax purpose? It can be, Jody. I don't know if hope you were on the call when I talked about that, but it can be. It's kind of individual, right? It's not a blanket, scenario. My husband and I are divorced. Can I get some of his Social Security? We meet all the requirements, but yes. Yeah, you can. But it has to be more than yours. If it's not more than yours, you're just going to get your own. I know there's a number of approximately 65,000 if I in the year that you turn your full retirement age. Yeah, I think we talked about that, Joe. So if you have a follow-up question to that, let me know. All right, let's see here. You're welcome, Lori. Okay, I paid cash for my house and I've lived in it a year. I have 25,000 in savings and a 401k. No debt. I want to retire at 62, which will be 2 months. Well, then I hope you're getting the analysis because we'll tell you if that's good. That'll work. If you're not, that's not really enough information for me to answer whether or not that's doable. But if you're getting the analysis, I can absolutely tell you. I mean, the relevant things obviously are going to be what's your income need? How are you invested? Do you need to make any changes to that to make sure that you're able to generate the cash flow that you need? What's your longevity risk? Are you married, single? All of those kinds of details. Okay. I think with that, we'll go ahead and wrap up for today. Appreciate everyone in attendance. Do request your Social Security analysis and workbook if that's relevant to you. Again, you'll just go to ssworkbook.com, or you'll snap the QR code, or you'll delete on the browser where it says /live where you're at right now, and you'll type in workbook. All those methods will take you there, and you can get both the workbook and the analysis requested. With that, we'll go ahead and sign off for today. Thanks, everyone. Have a great night.